gets a lot of discussion is the so-called Securities Markets Program, SMP, because it has this sensitivity about it. This is the central bank, ECB, buying up government bonds. And this is exactly what is forbidden in the statutes of the ECB. And it has been, as it had been forbidden in the statutes of the Deutsche Bundesbank, and this is again the heritage of the Deutsche Bundesbank. Therefore, the ECB is very eager to say, well, this is not about buying bonds as such. It is not a policy of quantitative easing. This is just to correct specific market imperfections. And therefore, it's also not a program that has the effect of increasing the volume of money, because whatever liquidity is used, it is then sterilized the same week. It is just to intervene in specific markets. The market, of course, where ECB intervened at the start was Greece. When Greece was cut off from the markets, we have now, then we have Ireland and Portugal, and then of course you see the big jump in last fall when there was added Spain and Italy to this program. And now what you see is that now, especially after President Draghi, or Mr. Draghi became president, this program is more or less on hold. We haven't bought any bonds in the last month, and without ECB has of course always the policy we never pre-commit. So I cannot really say what we will do in the next weeks, and with all due respect, I wouldn't be allowed to tell you about it. But there is a clear policy line that we keep this SMP program as a kind of a fleeting being, but there is not an intention of using it in bigger, to a larger amount. So we think for several reasons. But I think one has to see that it has been a success. If there would not have been these interventions on the Italian markets, that would have created a negative spiral that could have destroyed capital markets in important parts of Europe. Because they were able to stabilize it, and therefore also because one has to be quite clear, this SMP program is always connected with a certain kind of direct or indirect conditions. It even in the case of Italy was going together with a change of government, with a new government that had economic credibility. So therefore Italy could gain credibility again. And today, as we see, Italy is able again to go to the markets. So it was a success. So in one specific sensitive period, you did you gave a certain amount of help, and then, but it is not permanent financing, and it should not be permanent financing. I think this is the point about this program. Of course, what you have to see this to compare this with the general picture. This is a bit, it looks nice and colorful, but it's not so easy to understand. But just to give you a short interpretation, this is a kind of the liquidity provision. Central bank is providing liquidity by giving loans to the banks, loans with, of course, with adequate collateral, and the innovation that to a certain extent substituted the SMP program was the introduction of a big 3-year tender. That means the ECB is prepared to give, to lend money again against collateral to lend money to the banks at 1% interest for 3 years without limit. So whatever the banks need, as long as they have adequate collateral, they get it. And they took it. So it was it was quite a big amount. And this week we will have the second round of this so-called LTRO, also this long-term operation, and the estimations about the volume are usually different from 300, 400 billion to 1,000 billion. You name it, nobody really knows, and we will see at the end of this week. But it had the effect that it gave a certain security to the markets. It was not so much the quantitative effect, because to a large extent this just substituted short-term provisions. It was the qualitative aspect. The banks were able to have a 3-year funding, and therefore a funding in a very critical part of the capital market that was more or less closed to them. So I think it was a clear success. We will do it now again, but I have to say, if number 1 was a success and maybe number 2 was a success, it doesn't mean that there has to follow number 3. So we will be very cautious and have a look about the effects, about the long-run effects. And as I said before, ECB is more, let's say, on the cautious side. So therefore, whatever we decide, whenever we have a new instrument, at the same time we discuss how to end it. So what's called the exit strategy. So therefore, of course, this is not a problem if you have short-term liquidity, because then you know if you give a loan for 1 week, after a week you will get the liquidity back. With a 3-year liquidity provision, this is more of a sensitive issue. So therefore, again, you have to have an idea how does it fit into the general picture, what are the potential exit strategies. There are strategies we can control this, but therefore I would warn against the idea that this is now a regular feature coming every second month. I think that should not be the idea. I think it is important to see that this is the field of monetary policy. But monetary policy is only one part of general policy. And one should not overburden monetary policy, because with tasks they cannot or they're not allowed to fulfill. And therefore I think it's important to see all the other elements of economic policy in Europe. So this is the fiscal policy side, where we have, let's say, basically an enhanced stability and growth pact, a very ambitious one with the idea that in a 5 years' time we should have a structural deficit of 0%, which is, of course, quite ambitious with expenditure rules that breaks. We have as a second line structural policy. And of course, again here I'd like to have a bit of a word of warning. In every announcement of the EU Commission, and I have to say also of the ECB, there's typically one last paragraph and said, well, we need structural reform. The question is, of course, what is structural reform? So there is now from the side of the EU Commission, we have certain ideas about it, so with regard to technology, with regard to competition policy and so on. And of course, always labor market reform is a relevant point. And here I want to, again here with being at the university. I want to make perhaps a little remark with regard to labor market reforms and the role of social systems in the welfare state. This weekend there had been an interview by President Mario Draghi, where at least it was quoted that the welfare state in Europe is dead. And I think one has to see this in the right perspective. If this means labor market reform in a number of southern countries, I think this is fully justified. But again, we should differentiate. Many of the most successful countries today, the Scandinavian countries, Germany, Austria, Finland, they do have a system of, let's say, a modern European welfare state. And they have also a system of labor markets that is not the type of American labor. And this proved to be very beneficial because it means that there is no absolute flexibility on the labor market. For instance, that it means that in the crisis, the enterprises reacted by not firing immediately their employees, but resorting to what's called part-time work, Kurzarbeit, so short-term. So that means they stayed in the factory for a shorter period of time with a certain loss of income, but they did not lose their qualification. And this is one of the main points that the economists among you, and I think all of you are economists, they know this problem of hysteresis. That means that longer unemployment leads to disqualification, and that means to a lower potential growth of the economy as such. And that means that then if the economy goes up, you at a rather soon period get into bottlenecks with inflationary effects. This, let's say, continental European system had the effect that when exports became stronger, there was a labor force available that could deliver and that was qualified enough to be immediately possible to produce, to follow this demand. So I think we should be very careful and explicit about what we think when we speak about labor market reform. Of course, there are always a number of issues that can be discussed in detail, but I would be a bit warning against a model that would say our model is the American style of labor markets. I think that especially the efficient countries of Europe have shown that there are other more efficient models, and I think it's a good thing to stick to that. So this is the structural policy side. Concerning the crisis management, this is what we are just now on with the EFSF. This is this fund where it's coming from, and this should then be transferred or transformed into the ESM, the European Stability Mechanism. This is just now also a rather hotly disputed element. We have just now, and was the meeting of the G20 this weekend, where there is a discussion between the Europeans and the IMF. Of course, the Europeans are also part of the IMF and the paying part of the IMF. But IMF is kind of conditioning a stronger participation in the program for Greece with building up, as it's called, higher firewalls. And firewalls means these are the firewalls. ESM, that means higher, bigger funds that could intervene. And this is also the position of the Austrian government and the German government, I'm not convinced that this is necessary at this time. I think our priority should be to get all this in action, so really to have it working. If need comes, we will see, but we never must forget this is all taxpayers' money. And I think we should not be too easygoing with taxpayers' money, and we cannot be, because we have to be very much aware that there should not be a public revolt against, let's say, a bigger involvement. So I think this is something that one cannot look at only, let's say, from a technocratic point of view, but where you have also to see the political possibilities and the perspectives that you have. And then we have, of course, a whole system of the financial markets. And this is, let's say, the preventive part of our policy. Because what is quite clear is that this crisis we are in, and this is still following us, had its origin, not the only cause, but at least the origin, of course, on the financial markets. And especially in a situation where we had a very strong policy of deregulation of financial markets. And especially Alan Greenspan was a very strong advocate for this. And it is ignoring that financial markets are markets where we have this pervasive economic problem of asymmetric information. Therefore, markets cannot function without regulation. And so this massive deregulation led to rather negative results. Now we are in a different kind of process. Now we are in the process of re-regulation. And again, I think there should be a warning word, because there is the danger we overdid deregulation, but we might also overdo re-regulation, and doing too much on the other side. We have a number of institutions. We have the ESRB, the European Systemic Risk Board. I'm also a member of this board. So this is about systemic risks. That means risks that are not related only to one specific bank, like we have it in the usual banking supervision, but risks that are encompassing. For instance, risks due to new products, risks to lending in foreign currency, or something like this. So this are these systemic risks, and we have seen in this crisis the real dangerous risks are always the systemic risks, because these are the ones that are the costly ones. We have a whole system now of European financial supervision. Here in London, we have EBA, the European Banking Agency, as a kind of European banking supervisor, and we have the financial regulation, is Basel III. So I don't want to go into the details, but I think it is important to see that we have to have the full picture of financial and economic policy. Monetary policy plays an important role, but fiscal policy, structural policy, and the whole aspects of, let's say, administrative and supervision policy also play a role. And so we are building now on many sides. And I think basically that we have made progress. I think that we have set up a number of institutions that work, but it takes time. And so therefore, there is of course a certain feeling, and we are often asked, has anything changed after the crisis? And the answer is yes, but unfortunately it is not fully visible, which is of course perhaps not a very strong answer to say thank you, but please wait a bit. But in economics, economic policy, you have to have this realistic perspective that it needs changes, and to a certain extent, of course, also it needs changes in attitudes. And so that would mean we have to wait till we have a new generation of bankers, but this might be a bit too long to wait. So therefore, we have to see that we have kind of administrative system and supervisory system that is working this way. So I want to stop at this moment to have time for discussion. Just to wrap up on the role of the euro. I think that one has to distinguish between the euro as a currency and the members of the European Monetary Union. As you as economists know, a currency has to fulfill certain functions. And one function is, of course, to serve as a means of payment. The euro, of course, is an accepted means of payment in the euro area. Increasingly also international, about 27% of the world currency reserves are held in euros, with an increasing percentage. The second function of a currency is the function of store of value, and that means price stability. The ECB defines price stability as a rate of inflation not above but close to 2%. In the 11 years of the existence of the euro, the inflation rate has been 1.97%. So it was almost exact achieved. Of course, this is for the whole period of time. There have been, of course, aberrations during this time, which is a much lower rate compared to the 10 years before the existence of the euro, of the D-mark, of the shilling, of the national currencies. So I think the euro as a currency is a success, and it is to stay. What we do have is that we have problems in some member countries of the Eurozone, and this is the instruments with which we want to overcome these problems. Again, this will need time, but it will need a lot of work, and it will need a lot of good brains. And I hope a number of these good brains come from this school. Thank you very much.